Welcome to all my Wyckoff friends. I'm so glad you're here. And for you new people, when it comes to Wyckoff, resistance is futile. Anyway, we're going to have a great episode today. I'm going to go really fast because there's a lot to cover. And the first thing I want to do is continue on a little bit with our discussion about inflation from last week. There's some additional points I wanted to make I couldn't get to. And then also we're going to get into the price cycle, talk about the importance of the price cycle related to recession and recession watch. And one of the ways we're going to do that is by looking at the yield curve. So here, the Wyckoff price cycle is the price cycle of the stock market. Individual stocks, they ebb and flow. They have their own heartbeat within the structure of the total stock market, but also they rhyme in most cases to what the stock market is doing. Mr. Wyckoff was really so brilliant on understanding the price cycle. And so we're going to talk about that today a little bit related to recession watch. So the other topic that we're going to cover, especially related to the yield curve and the fact that it's flattening right now, is the idea of recession watch and tight money timing, because the definition of a flattening yield curve is a tight money environment. So how tight is it? Can the market rally when the yield curve has flattened? Can the market rally when interest rates are going up? We probably can't cover it all today, but we're going to. And in future episodes, I will have some very special guests that are really good at analyzing these conditions. So will inflation return to normal levels? This is one of the areas that I wanted to cover more last week, and we will get into that a little bit. And then the present position of stock indexes at this time, and then followed up by sectors, groups, and stocks. And I can hear you thinking, you're going, gosh, is he bitten off more than he can chew? And I'm absolutely here to confirm that that's true. So here you can see the classic price cycle. Excuse the fuzziness. You've all seen this chart before. This is from Roman. He did this as a class project back in the 90s. It's a brilliant chart. And you can see here accumulation across the bottom of the price cycle. You can see the price cycle here as defined as like a moving average. It's not specifically a moving average, but you can see the price cycle. So accumulation, markup, distribution, markdown. Now, this is the really important part that I want to make, and this is all I'm going to talk about relative to this chart. And that is that the economic cycle lags the stock market price cycle. Think of it as being a six-month lag. And get my little marker back here. And so we're looking out 6 months in time. So the economic cycle is going to look something like this. This is very simplistic, I know. But the top in economic conditions and the slowdown comes at some point after the distributional top is put in stock prices. So they're not lined up with each other. And here, down here, you can see that the stock market will go under accumulation, will start to mark up, and the economy is still getting weaker. And so it's looking out 6 months into the future and seeing, and this is just 6 months is just sort of a, average relationship, but it will look out into the future, the stock market, and discount better conditions coming, will act ahead of the economy. This is one of the reasons why it's so difficult for investors to be able to make good timing decisions, is because the economy, the economic cycle and the economy itself puts us into either a good mood or a bad mood. And so when the economy, we're in recession, business is slowing, stocks are down, all of those things, we're in an economic psychological environment that's quite negative. it doesn't start to feel better for investors until you're already well into the advance in the economy. But look at how far up stock prices are by the time this is really a feel-good place. So you have to be willing to make decisions in the face of tremendous uncertainty, tremendous bad news at the bottom, and then in the glow of good news at the top, when the economy is super strong, earnings are good, all of a sudden stocks start to tail off. They act worse. They distribute themselves. And so into the face of the glow of great news, great conditions, the stock market starts to just drop. And so our emotions are never aligned with what's going on in the stock market. Now, let me go here to the CPI chart, which I showed you last time. Here, this is the 7.9 was the most recent reading. You can see 7.75. It's quarter point scaling. And so you can see we touched 7.75. We have not touched 8 yet. Very close, 7.9. We're very close. We're probably going to hit it in the next reporting period for March. Will the consumer pricing index continue to go higher and hit these higher numbers? It very well could. But my argument was that we, especially with tight money coming, that we may start to get some kind of a slowing here, and then maybe we could get a reaction of some type where it comes back some. I don't think it can come back very much. As a matter of fact, it wouldn't surprise me at all if we didn't come down into the 6-7% range. And this will not feel good to anybody, because 6-7% inflation is, I would describe, a disaster, and especially for savers and for investors and for people on incomes, retirees. This is 2% inflation is no good. Think of it this way: 2% inflation over 10 years, a decade, is more than a 20% reduction in purchasing power for the dollar. So can you imagine what 6% does? And here we are flirting with the 8% level, with the potential of it going higher. So if there is some kind of a backing up type action here down into the 6s or the 7s, this is going to be a Pyrrhic victory at best. It's not going to be a good thing. It's possible that the powers that be could declare victory because this line is going down. For us, our job is to maintain our purchasing power, especially in a world with a deteriorating purchasing power of the dollar. This is our job to be done. And so this is why we're going to keep working on this in the weeks ahead. I'd like to point out here that we are going to have a Wyckoff market discussion complimentary session on April 6th. Love for you to be there. Go to wyckoffanalytics.com and register for that event. It's really a lot of fun. Ramon and I spend an hour and a half just going over the current market from a Wyckoffian perspective, going into special topics and so on. So we really would like you to join us for that. So here you can see this inflation migration. This chart actually created a little bit of controversy. Not a bad thing. I love controversy. I appreciate your feedback and letting me know your thinking. And there was some discussion about commodities, because this is a ratio of the NASDAQ 100 large cap growth stocks to the CRB Reuters commodity index. And so my contention is that we have a overbought condition after a 10-year uptrend of growth stocks to commodities and virtually just about everything else. But after that overbought condition above the trend channel here in 2020, in the beginning of the second quarter of 2020, really kind of unbeknownst to people, because there was just tremendous party of speculation all through this period. But what does this look like? Think back to the chart we just looked at. Here is the price cycle. And so here's our big uptrend. here's a potential price cycle distribution area and a markdown, and look at how much the commodity prices are outperforming stock prices, especially the most important growth stocks. I contend that these growth stocks have become a source of capital for the composite operator types, and they are using their sales and their prior sales of these large cap stocks to go into other areas of the market. The controversy really was about whether or not commodities is a solid place to be. And I'm not saying that it is at all. I'm showing you the phenomenon of what's going on here on a relative strength chart. But what I am saying, and what I think we're seeing in the country, in the world, is that these large moneyed interests that are really on the cutting leading edge, they're the ones that create accumulations. They're the ones that create distributions because they are thinking 6 months to a year ahead of the economy. They are the ones that are the best at anticipatory behavior in the financial markets. And this is just a reflection of a condition that's much wider. And that condition is that money is starting to migrate into real assets, whether it be farmland or whether it be commodities or the energy sector in the form of stocks or actually owning energy producing properties, etc. There are many, many ways to participate in the real economy if these prices are growing faster than stock prices, if these prices are growing faster than inflation. That's the key. And the other part of this that we've talked about, and I've gone on a rant here, but the other part of this is that when you have 8% inflation across the board, you have 15, 20%, 30% inflation in food and energy and these other places, there is a huge yawning gap of opportunity for these speculators to be able to borrow money at low interest rates and be able to speculate and accumulate these assets that are appreciating at these much higher levels. They can cover the cost of borrowing money, they can pay the interest on that, and then they can leverage that ownership by growing the value of those commodity assets. Now, commodities, we need to think of this in a much broader term than thinking about it just as the commodity market. It's many, many different things. And so I use this as a somewhat of a symbolic reflection of what's really going on. But also keep in mind here that this drop has been quite dramatic, and that this drop is likely to have a counter trend move of sorts. And it could very well be that it could move all the way back up into this trend line, maybe even into the channel. Who knows? But we'll be watching and keeping an eye on it right here. So anyway, this is just to further reflect on these issues. And again, if I can't get to all this today, oh, by the way, I'm doing a YD5 on Monday with Johnny Scan, so tune into that also. Yield curve. We talked about the yield curve last week. And so here you can see is over here, there's a point and figure chart that we made of the 10-year yield. And so there's a cause built back to 2019. I showed this last week. I won't spend much time on it, but it shows a count potential that goes up as high as 3.2%. And so here is the prior high that was made in 2018, right at 3.2%. So there's classic resistance up here, right where our point and figure extreme target is, makes perfect sense for where yields could go. Now you're thinking, because you're all just really sharp Wyckofians, you're thinking, well, 3.2% is nowhere near 8% inflation. And in fact, what has to happen, and we saw this with Paul Volcker and some other really good Fed chiefs, is that interest rates, to stop inflation cold in its tracks, you must get the interest rate, the risk-free interest rate, up to the level of the inflation rate, arguably even higher. The normal relationship is for interest rates to have a positive yield, the risk-free rate, which would be Fed funds, a positive interest rate to the inflation rate. So that would be something above 8%. And that's why the Fed is so shocked right now about how high these inflation levels are and why they so desperately want them to be transitory, because the notion of getting interest rates up to anywhere near that level is just would be a shocking event for the economy. And the Fed knows this. And so they have, basically two mandates. One is full employment, and the other is steady, stable prices, low inflation, or no inflation, preferably. And so here they are. These two things, unemployment rate or employment rate, let's say, and stable prices, are really contrary to each other in policy decisions. You raise interest rates, you create a tight money environment, and in that environment, it's going to inevitably result in a slowing economy and higher levels of unemployment. So these two conditions work against each other. And so the Fed's got to make tough political decisions to be able to create a steady state environment where conditions are good for economic growth, good for stable prices. Hard to do. And they are in contrast to each other. Here on the right is the yield curve. And the yield curve, as you can see, is dropping precipitously. It's down about 20 basis points. This is the 2-10 yield curve. All that is just 2-year US Treasury yields minus 10-year US Treasury yields plotted. And so when the number is positive, that means 10-year yields are above 2-year yields. When it's negative, it means that the yield curve is inverted. 2-year yields are higher than 10-year yields. Kind of nonsensical, but that's in fact something that does occur. And so look here, look at this beautiful accumulation structure in the yield curve chart. They're everywhere. And so you can see these beautiful accumulations and distributions along the way. Well, now we're seeing interest rates, these bottom two lines. This is the 10-year here. Here's the 2-year. They're both rising. Well, let's look at this more from a historical perspective. I showed this to you last week. Now let's look at a little different view. And this is the yield curve history going back to 1990. And so this is the 210 yield curve. There's other yield curves. You can do 6-month 10-year, you can do 5-year 10-year, and so on. 2-year 10-year is widely followed. Probably others are just as widely followed. Well, let's keep in mind here that this pink line is zero bounded yield curve levels. And so there is definitely a history of the yield curve going negative. Now, what does that mean from the sense of the economy here? Well, what it means is that the yield curve is in a tight money situation. This is tight money, easy money timing. When interest rates, when the yield curve flattens, that means that we have a tight money situation. Tight money tends to slow the economy. You can see here that we have cases where we touched the zero bounded area, and I put the arrow up here where that happened. You can see that it sometimes produced a range bound condition, but then the uptrend continued. Here it had a bit of a correction, and then the uptrend continued. Here we had a bit of a we just had a little bit of a slowdown. Then it went up into the COVID peak and decline, which was substantial, but that was about 7-8 months later. And so it can result in a correction, but it can be followed by a continuation of the rising trend of the indexes. In this case, it's the S&P 500. But notice here, when the yield curve starts to live below zero, here and here. So in this case, this is around 2000. And look at this distributional top that we have in the S&P 500 at the time that the yield curve goes negative. This is a tight money environment right there. Then you have an 0607, you are living below the yield curve below zero here, and you have, this occurs about, gosh, a year before the final high in the stock market. And look at how the stock market starts to distribute itself. And in both these cases, we had recessions. So I would contend right now, what do we know? We know that the yield curve is still positive. It may just go down and touch the area of the zero bound, but it might just stay above it. We just at this point don't know. But typically when that happens, we have maybe a correction, but we just as likely could have a continuation of the rising stock index values after that. So we'll keep looking at this. I would just say there's going to be a lot of discussion in the financial press about yield curves going negative and so on. And I would put that into the context of history and just say, again, what we want to do is we want to focus on what the markets are actually doing. Look at distribution and accumulation characteristics. Okay, so that's what I kind of wanted to cover there. And now let's move on, and we'll come back to this and do more on it. And so here is the New York Composite. I haven't talked about that much here recently, but it's a great index to look at. This is all the New York listed stocks. And so you can see a sign of weakness here. And now a really good rally. I think we've done a great job of identifying the conditions for a rally in the market, and we got it. So we're feeling pretty good about that. Here's the S&P 500. This is what's happened since September. So you can see the attributes of distribution have occurred here. We've gone down on this point figure count, 60-minute 3-box reversal, 15-point scale. You can see we went right down and went right into the middle of this count objective range. And subsequently, we've rallied nicely from there. This chart hasn't been updated for a while, so I just wanted to mainly show you that this initial distribution count. Now, here, you can see that we could get a much bigger distribution count at some point. A point I want to make on this chart is here's what we call preliminary supply in Wyckoff terms. This is the first run up that has an important reaction, which is brief, temporary, and then the uptrend is resumed. This actually is very encouraging to people. And so people are encouraged because the uptrend keeps going, but it's a warning. This is a huge warning. And in fact, the buying climax followed in the next rally phase up, and thereafter range bound conditions and somewhat of a distributional formation is formed. Now, preliminary supply often is the point at which last points of supply will stop. Here you can see 2 attempts, 1 day only each, to get above that preliminary supply resistance and failure. And we're getting very close to that again. Now, there's reason to think that this is a pretty good rally and may have some additional momentum, but we'll have to come back to that and look at it later. Here, and so you can see that here is just the S&P as we've gone through, and it's come out of that upward trending channel. But all the way since 2011, these point figure counts have just worked really, really well. So let's see, what else can we do here that we have time for before. Here you can see, and we have about a minute left. Here's the triple Qs. You can see that into the fall, this is October, November, and here that we fulfilled 2-point figure counts and then became range bound, came back into the channel, formed a distribution, got a count. Here is that count. And you can see that we declined right into the area of that, which has subsequently produced a rally. And so that's really a very interesting condition. So let's go and look. Here's an update on the triple Qs. You can see how stellar this swing trading rally has been. Maybe in the context of the larger picture, it's still not significant, but it is promising. And with that, I'll say goodbye for now, but we'll come back next week and we'll pick up on sector studies, and we're also going to do more on breadth. And with that, thank you so much for being here, and I'll see you next time.